Today I'm going to talk a little bit about why people should invest in structured products, and probably a couple of the reasons why people haven't invested as heavily into structured products as they have in Europe is really been because the issuers haven't been out there. Over the last few years, a number of banks have come into the structured products market, and we've also seen the benefits, when in the early 2000s, South African markets did very well, and people didn't feel the need for things like capital protection. So over the last couple of years, we've seen a shift away from active asset management, more towards passive and indexation. And with that, we're seeing an upsurge in structured products as well. So really, there's a number of different benefits that you can get from structured products. And I think the first one is really that when you enter into a structured product, you have a clearly defined investment objective. For example, if you were investing in the S&P 500, for example, structured products very often work in conjunction with caps and floors. So you might have a product that tells you you're invested in the S&P 500 for a certain period, let's say 3 years. You would get 100% of any upside in the product and no downside in the product. So if the market fell over a 3-year period, you wouldn't have any losses. Similarly, if the market went up, you would get the full gains. And that's really where the structured products, they define those investment outcomes before you actually invest in the product. Another area where structured products work very well is that they can actually enhance returns. So if we use the example of the S&P 500, we have products out in the market where while they invest in the S&P 500, they offer gearing into those. So if the market was to go up 10%, they would actually go up 15% because they're 1.5 times geared. And again, we use caps and floors, so you might only have 50% downside protection. That means that if the market fell more than 50%, you might sustain a loss. But over the last 50 years, we haven't seen the S&P 500 lose more than 50% in a period. So you can very much tailor them to specific needs. What we like to do with structured products is take out some risk and add a little bit of gearing to the upside where we can. Another area where structured products are really beneficial is in the capital protection side. So by capital protection, we mean that if your chosen share or commodity that you're invested in actually falls over the investment period, you would actually receive your money back at the end of that period. And capital protection works in many different ways. You have full capital protection, where you get back 100% of your money, or you have partial capital protection, whereby, for example, we have one of our products, the Geared Growth, offers protection for the first 20% of fall in the market. So for example, if the market fell 25%, you would only sustain a 5% loss in that case, because we would take the first 20%. So you can really see the value of different levels of capital protection. And I think with most things, you find the more capital protection that you are given or you receive, it means that you have less upside. So a larger floor means a lower cap in many of the cases. And it really allows people to tailor their investments for the type of risk that they're willing to take. Another benefit for structured products is you can have access to many different asset classes. If you're an investor on the JSE, although there's a number of different products and more being listed, really the investor is limited towards the equity side of the market. With structured products, we bring in different asset classes. So we might have a structured product which allows the investor to gain exposure to things like commodities. We might put together a basket of commodities. We have an Agricom 1 product whereby investors actually received an investment into a basket of agricultural commodities. We've also done products over different company bonds, for example. So corporate debt is another area where we've put structured products together. And that really allows the investor to diversify their portfolio while still buying one instrument. And because we list most of our products on the JSE, it actually allows them to use their existing stockbroking accounts and actually gain access to different types of markets, not only South African, offshore, but also to commodities and corporate debt as well. Another area where people have, over the last couple of years, have really shied away is manager risk. In many investments, you have quite a large manager risk if you're using a specific asset management firm, or with the growth of hedge funds, we've seen a lot of people move into those. And really by using structured products, which tend to use indexation or passive investments, people can get exposure to investments for much lower fees, and it's very much linked to specific indices or a basket of different stocks. Structured products are designed to run in a tranche type system. So we would open a tranche for possibly 6 weeks selling period. We then close it, and the investor is then invested for a specific period. Now, most of our products run from 1 to 5 years. There are a few that run a little bit longer, but we find that the sort of sweet spot for people is between the 3 and the 5 year area. And many of our products are structured in such a way that if the investor holds them for the term between 3 and 5 years, that they're also tax efficient as well. So we like to put together structures that consider the timing, provide some gearing to the upside or exposure to a particular asset class that people don't have exposure to, and then put the product together for a specific period and try and make it as tax efficient as possible. And that's really why we're seeing an upsurge in people looking to invest in structured products.